Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 3rd of March. I'm Daniel Lam, your host for the podcast. The market is extremely dazed and confused, with a lot of rotation within the tech sector and also across the sectors. There's now, of course, the escalation in geopolitical tensions, which means the picture is even murkier than before. However, in general, in order for the uptrend to pick up again in equities, the US tech sector needs to be bid again, and the reversal in the hard assets and defensives would reverse. Last week, an extremely prominent semiconductor stock reported strong revenue beat, but the stock got sold off in the first session after the results. Investors are truly lacking in conviction and unwilling to make big risk calls. This goes for institutional investors and also for retail as well. Their exposure to markets look elevated, but it is concentrated in ETFs rather than single stocks. Another signal that the vibe is one of low conviction. This setup will need to change for markets to break out of the current pattern. You need a rise in institutional activities alongside growing retail buying of single stocks. Now, currently, the technology underperformance is looking somewhat excessive. Positioning is no longer overstretched, but you do need a catalyst to change the momentum. The earnings for the semiconductor stock fail to be the catalyst, but this can be due to the current pessimism in the markets in general. Short interest is too elevated in major tech stocks that we can see short covering coming soon for these stocks. Now, in order for this to happen, positioning may need to be even lighter. And the current correction and uncertainties in the market may provide just that. Retail investors have jumped in to buy tech dips, but the subdued price action in this semiconductor stock shows that institutional investors are not convinced just yet. Dip buying in software is again largely confined to retail investors, with institutional participation, even at a single name level, largely missing. We want to see evidence of institutional flows turning positive to have confidence that the bleed in tech is over. A tech recovery could bring CTAs or the trend following funds back into the market and break the current environment. On the positive side, a tech rally could also see cyclical value sectors and rest of the world equities falling out of favor. The recent outperformance of the equal-weighted S&P 500 and demand for hard assets meant strong inflows into industrials, materials, and energy. Now, this means the sectors are looking increasingly overcrowded on a relative basis, especially now because of the events in the Middle East. If interest in tech does happen, we expect these cyclical value sectors to be amongst the most sold-off names. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.